everyone, I'm the Tax Pro, and today we are doing day 7 of our 90 Days to Taxes series, where I take new business owners who may be disorganized, help you get organized, help you get ready for tax season, get ready to file with those deductions, claim those credits, all that good stuff. Today we are talking about the business use of your home, and we're going to start with publication 587. This is a publication that is on the IRS website, very helpful. Keep in mind that we can't use these publications to defend ourselves in an audit because they do not have what we call authority, but they make great introductory material to start your research. And this publication in particular is very well laid out, so I am going to use it to help us kind of navigate business use of your home. So when it comes to business use of your home, the way that you claim this is going to be dependent on how you're taxed, how your business is taxed. If you are unsure how your business is taxed, go ahead and click on video 1 in the 90 Days to Taxes series, and I'll walk you through how your business is actually taxed. So let's take a look at how we qualify to claim part of our home in a business. So qualifying for the deduction right here, this is going to give you some information on what you need to do in order to be able to qualify to claim part of your home for your business. So the part of your home that you're using, it needs to be used exclusively and regularly as your principal place of business. There are some exceptions to this that I'll go into here in a minute, but let's talk about this. Exclusively. So exclusively is going to mean that that area of your home is not used for other things. So that area is strictly used for business. You don't have a project that you have going on the side, maybe for the home. You don't have your kids set up to study or play video games in here. You don't have some sort of craft or project that you're working on. You don't have, stuff for a W-2 job, or you don't have storage in here for personal items. It needs to be used exclusively for your business. Now, there was a court case where the taxpayer had claimed a home office and they had claimed a room, and on one side of that room was a personal use room, and the only way to get to that personal use room was to cut through the business use room. And the IRS tried to say, listen, that's personal use. You are going through that room and you are going to a personal room over there. So therefore, this is not used exclusively for business. This room also has a small personal component where you are going from one personal space to another personal space. It went to court, and tax court said, no, that's silly. They're not really even using it for personal. They're literally walking through it to get to that personal space. It doesn't count. So you do have to use it exclusively for business, but if you have to walk through it to get to another room, that's fine. It does not have to be like lock and key, only used for business. That didn't hold up in court. It does need to have only business stuff in it, and if you need to travel through it to get to another personal room, that is okay. Now, regularly as your principal place of business. So I see some questions that people often ask. Okay, well, I rent a space where maybe I meet with people, or I rent a space that maybe I hop into once or twice a week, and I, maybe do a little bit of business there. There's meeting rooms there. Maybe it's a co-working space. Maybe you touch base with employees there. Is that allowed? Can you have that place of business, but then also have this be the principal place of business, your home office? And the answer is it depends. Yes, it is. You can potentially have a home office that is considered your principal place of business regularly, while you also rent somewhere else. And I'll show you kind of some resources in this publication that'll help you determine what that looks like. So it doesn't have to be the only place of business. It just has to be regularly used as your principal place of business. Okay? Now, here it says, exclusively and regularly as a place where you meet or deal with patients, clients, or customers in the normal course of your trade or business. In the case of a separate structure that is not attached to your home in connection with your trade or business, what this means is you have a separate structure on your property. Maybe you have a shop that you've set up, you're storing equipment in there, or you're storing inventory in there, or that's where you do your business activities. Maybe you are a mechanic and you work out of your home or something along those lines. If that separate structure is business only, that separate structure can qualify as essentially a business use of your home. And so that it doesn't have to be connected or a part of your main home. You can have separate structures associated with your business that you claim. So you could have, I see this a lot with like farmers. I see this a lot with mechanics or construction. Maybe you have quite a bit of acreage, and then you only use a very small part for your personal property, for your personal residence. And the rest of it is utilized in a business. And the rest of it that is utilized in that business, if it is used exclusively for a business, it can be written off, okay? Now we have to be careful with that because there are some kind of repercussions for writing things off that I'll go into here in a minute. But if you have separate structures, like a whole entire building that's dedicated to a business, that's okay. Just because it's on your personal property does not mean that you can't write that off. Now, if you're using things, an area on a regular basis for certain storage, you can write that area off. And then the exclusive and regularly as your principal place of business, that doesn't necessarily qualify. For rental use, maybe you are renting out a portion of your home. Maybe you have a mother-in-law suite that you're renting out. You could then write off that portion of your home you're renting. Daycare facilities are a little bit different. So daycare facilities are obviously going to use a lot larger portion of your home, and you're probably not using that daycare area exclusively for business. Those kids are probably hanging out in your living room. You maybe have like a toy room for them. You're probably utilizing your kitchen for that daycare. And just because those are mixed use, when you have a daycare, you follow a little bit different regulations. Okay, so exceptions here to exclusive use. You do not have to meet the exclusive use test if either of the following applies. You use the part of your home in question for the storage of inventory or product samples, okay? Or you use the part of your home in question as a daycare facility. So there's additional information in this publication about both of these scenarios that would be helpful if this is you. So if this is you, go ahead and look at publication 587. I'm not going to go too in depth in here just because these are very specific scenarios that a lot of people maybe aren't experiencing. But if you have storage of inventory or product samples, that's a different story. So here, principal place of business. You can have more than one business location, including your home, for a single trade or business. To qualify to deduct the expenses for the business use of your home under the principal place of business test, your home must be your principal place of business for that trade or business. To determine whether your home is your principal place of business, you must consider the relative importance of the activities performed at each place where you conduct business and the amount of time spent at each place where you conduct business. So kind of think of it this way. There are a lot of businesses that have multiple locations, right? So you maybe have a location in this city and a location in this city, but those are owned by the same businesses. Just because there's more than one location doesn't mean that only one location is allowed to be written off. So you're going to look to see how imperative is the business use of your home in that business. Are you using it exclusively and regularly for administrative or management activities? Maybe you have staff that work at that location, but you manage them mostly from your home office. You have no other fixed location where you conduct substantial administrative or management activities. So if I do all of my management, like all of my substantial administration here, and then those other locations maybe work with filling services or something along those lines, but really the powerhouse, so to speak, and the running of it is from my home office. My home office is still considered a principal place of business. So this is going to give you some more examples. What is administration or management activities? Are you billing customers, clients, or patients? Are you keeping books and records? Are you ordering supplies? Are you setting up appointments? All of that good stuff. So do you have administrative or management activities performed at other locations? And then this is going to give you kind of some workflows to go through if you have any questions about this. I'm not going to go too in depth just because I don't want to make this video extremely long. If you have more than one trade or business, you can sit and read this, how this works for writing off that home office. You can use your home office for more than one trade or business activity. You can have, is it used as a place to meet patients, clients, or customers? this gives you information on a separate structure. So do you have a separate freestanding structure? Now, one thing to keep in mind is if you have a separate freestanding structure, how are the utilities split? Okay, do you have a separate meter on that structure? Some people don't, and that's okay. But if you don't have a separate meter on that structure and you get one utility bill for all the different structures, we are not going to write off all of the utilities, right? Because a portion of that utility bill is going to be personal use. And the IRS is going to want to see how you determined what percentage is personal versus business and how you decided what amount to write off. Okay, you want to have support for that. Did you determine, that it was equal usage per square foot? Or did you look to see, okay, prior to installing this structure, my utility bill was roughly this amount. This is what we were using as far as kilowatts every month. And this was, the amount of energy that we were using. And then when we installed that, we started using this amount. And that's how we determined percentage, or that's how we determined, the amount that we're deducting for business, what we're leaving for personal, all that good stuff. This is going to give you information about figuring the deduction. So there's two ways that we can actually figure this deduction. We can do the simplified method, or we can do actual expenses. Simplified method looks at how much square footage do you have in your business home office. What does the square footage look like? So if we have a 10 by 10 office, then we're going to take that 10 by 10. We have 100 square feet, and we are going to multiply it by 5. And that is our simplified method. Super easy. Actual expenses is a whole nother beast. It is where we are going to look at multiple different types of expenses. And there's a great chart down here. So there's going to be actual expenses. We're going to look at direct expenses. So this is only for the business part of your home. So painting or repairs only in that particular area. So this is deductible in full. Now, obviously, there are some exceptions here. There's always going to be exceptions. Indirect. So the cost of keeping up and running your entire home. Insurance, utilities, general repairs. And then we have completely unrelated. So let's say that, this is my home office room, and it's obviously not in my living room. So I redid my living room and I spent $10,000 redoing my living room. My living room has nothing to do with my home office. Those would be considered unrelated expenses. I would not deduct those. Whereas my utilities, my insurance, and maybe I got, some patches in the insulation or something along those lines. Those would be indirect expenses. I would take a percentage. So I'm going to look at the percentage of square footage used in my home office versus the rest of my house. That's the percentage that I'm going to take of my indirect expenses. However, if I come in and I do a completely new floor in my particular home office, I do some really, really nice painting and then have some nice shelves put in there because that's, I want to impress my clients when they come in here. Then that is going to be direct expenses. That would be deductible in full. So that's how you use actual expenses. Actual expenses can oftentimes get you a higher deduction. It just takes a lot more tracking, especially if you are going in and you are really revamping your home office and it's looking really, really nice for clients to come see you. That can oftentimes get you a better deduction. So right here, it's going to show you Form 8829. This is to be used with Schedule C. You could also use this with Schedule F. This is going to show you how you calculate, this is the form that you file. So this is going to show you how you calculate the business use of your home, what you get to claim. This is for sole proprietorships only though. Okay, so how do we deduct things for partnerships? How do we deduct things for S corporations? How do we deduct things for C corporations? It's a great question that a lot of people have. So this is going to be for sole proprietorships. This 8829 is going to go on there. When it comes to partnerships are a little bit different than our corporations. When it comes to partnerships, we can either have you need to have something written in the partnership agreement that is going to tell us, are we either going to is the partnership going to reimburse those partners for the business use of this home, or is the partnership not going to reimburse? And if it's not going to reimburse, it needs to be in writing that the partnership's not going to reimburse the partners for the business use of the home. Has to be an agreement in writing on how the partnership's going to handle that. If the partnership is going to reimburse for the business use of the home, you need to have an accountable plan written up, and there needs to be a detailed written explanation as to how you are calculating what the reimbursement is going to look like, okay? I recommend doing some form of the calculation that is acceptable on the Schedule C, because that is, standard on a tax return, right? It's written, there's already calculations, you have your simplified method and your actual expenses. I like doing a kind of a mere calculation for partnerships. And then the partnership either reimburses that partner. That reimbursement is not taxable to that partner, but it is deductible on the partnership tax return. Okay? If the partnership is not going to reimburse the partner, you can take something called unreimbursed partnership expenses, and I think this publication actually talks about it. Let me see here. So this is going to talk about depreciation. I'll get to that in a minute because that is important. Okay. I believe we have unreimbursed partnership expense explanation here in this publication 587. Okay, where to deduct? Business use of your home. Partners right here. So you may be allowed, I'm just going to read this. You may be allowed to deduct unreimbursed ordinary and necessary expenses you paid on behalf of the partnership, including qualified expenses for the business use of your home. What ends up happening is you will have unreimbursed partnership expenses. We call them UPE. And the UPE is going to live on Schedule E. Okay, so UPE will live on Schedule E. When the partnership files its tax return, a Schedule K1 is prepared. That Schedule K1 tells the partner what their share of the income and the loss items are from the partnership. That information goes on to Schedule E. There is a line item on page 2 of Schedule E that will be where you enter that Schedule K1 information. If you are taking unreimbursed partnership expenses, or this UPE, the UPE will also live on page 2 of your Schedule E. And that UPE will be unreimbursed expenses that you incurred as part of the partnership business activity. Okay? UPE is important because it is a way for partners to deduct unreimbursed expenses. If your partnership is not reimbursing you for expenses, that does not mean that that deduction is lost. Okay? You can deduct unreimbursed partnership expenses on your Schedule E. So there's kind of two ways that you can deduct your home office when you are a partner in a partnership, either via reimbursed expenses or unreimbursed partnership expenses. It needs to be in writing if the partnership is going to reimburse them or not, in order to support that. Even if the partnership's not going to reimburse it, it should be in writing, and then you can claim your UPE. So that's partnerships. Let's talk about S corporations and C corporations. S corporations are a little bit different. You can have a accountable plan that is going to allow the S corporation to reimburse employees because you're going to be an employee in that S corporation, right? You need to be on W-2 payroll if you're a shareholder working in or on the S corp. And if you have a home office as part of that, then you would have what we call an accountable plan, which is a written plan for that S corporation that is going to detail how employees are reimbursed for expenses that they incur for things such as home offices. Okay? That home office expense would then be deductible on your S corp return, and then it would not be taxable to you as an employee of that S corporation. Okay? C corporations are going to be the same thing. You as an employee can receive a reimbursement for expenses. It just needs to be in a written plan. Okay, so What it kind of boils down to is the IRS really likes you to have things in writing. They really like you to have these just like detailed written agreements, like an accountable plan and an S corporation. I don't care if you are the sole shareholder of an S corporation, and you're like, oh, we're in our meeting minutes and we're gonna agree to have, this accountable plan that's gonna reimburse us for business use of our home. Go ahead and do it. Do a written accountable plan. Sign the written accountable plan. It's really important to have that in writing. I always like to prepare for an audit before we even have an audit, because then if you're prepared and everything is documented the way that it needs to be, it's really easy in the event of an audit where the IRS says, oh, we want to audit this, like home office. What's going on here? And you say, oh yeah, here's the written agreements. Here's everything that we have. This is all above par. Everything looks good. Here you go, IRS. And the IRS says, oh, okay. And then moves on, hopefully, right? So I always like to prepare for that audit before it happens. So as corporations, C corporations, you need to have a written agreement. Partnerships, same thing, written agreement, but maybe you just don't get reimbursed. You can still take on reimbursed partnership expenses, UPE, on Schedule E. If you have a Schedule C or a Schedule F activity, sole proprietorship, then you would fill out this Form 8829 right here, and this is going to be filed with your Form 1040. So that is home office expenses. I do want to cover depreciation on your home, because that's important, and then I also want to cover the depreciation on your home, and then how this is different from something called the Augusta loophole that you may have heard about. So when it comes to depreciation on your home, you can claim depreciation on your home when you have an asset and you are using that asset in the course of a business. That asset, we write off that asset via depreciation. What that means is we say, okay, this asset is going to lose value while we consume that asset in the course of the business use. So if we have a vehicle, for example, that vehicle is not going to be worth the same amount as the day that we buy it on the day that we retire it, most likely, right? So we're going to use up that vehicle in a way. And depreciation is the way that we write off the cost of that vehicle over the course of what we assume is going to be its useful life. And useful life is defined by the IRS. We don't get to define the number of years of useful life that equipment is going to have. The IRS tells us we want you to depreciate this particular item over this number of years. Okay? So we are going to depreciate these items over the lifespan that the IRS gives us. Your home is going to be potentially eligible for depreciation, the portion that you are using in your business, which is great. It gives you a deduction. Now, the issue with that is that we have something called basis in these assets. And that basis generally starts with what you pay for that asset. And so if we purchase a home for $300,000, and we have recognized depreciation on that home over the course of doing business with that home of $25,000, that depreciation has reduced our basis in that home to $275,000. When we go to sell that home, our gain on that home is the sale price less our basis, not the purchase price, your basis in that home. Okay, so then you experience a gain, a larger gain, if you have written off and depreciated a portion of that home. So you're experiencing a larger gain, and if you end up reaching the threshold where you will be taxed on that gain, then you may have to do what we call depreciation recapture, where you are paying tax on the amount that you've depreciated. So you may experience a tax break in the years that you are depreciating that home, but you may pick up additional tax in the year that you sell the home. That's the downside to depreciating your residence, okay, or buildings on the property. So that depreciation reduces your basis, which can create tax down the road. So that's one thing to keep in mind. Now, I also want to touch base on how home office, the business use of your home office, is different from the Augusta loophole. So you may have seen, advertisements where you can rent your home to your business tax-free up to so many days. And it is a deduction on your business return, and it is not taxable on your personal return. And that is a legitimate thing. So the Augusta loophole is legitimate. It is named after Augusta, Georgia, where they have the masters. And what happened was the IRS, Congress said, yes, you can rent your home out for the masters. No problem. We're not going to make it taxable as long as you don't do it too much. And so the Internal Revenue Code actually has an area that says if you don't rent out your home more than so many days every year, but you rent it out a little bit, you don't have to pay tax on that income. And so tax planners said, you know what? What if that home was rented to the business? And then the business gets to deduct that expense. And the owner, as long as we stay under that threshold of days, doesn't have to recognize income that's taxable on the tax return. Okay, it's not taxable. So that's great. There's, certain things that need to be in place. Like you need to have a rental agreement. It needs to be for a legitimate business use. So maybe you have like a small office and, every 2 months or something, you like to have all of the employees over. You need a lot more room to spread out what you're selling. You do kind of like a learning event at your home where you need the space. So it doesn't make sense to use your actual office. You need a lot of space. You need to be able to spread out. You need to have different stations for different materials or different pieces of equipment or different things that you're selling so that the employees can go in and get educated on what they're selling. That would be like an example of a reasonable rental of the home, like a reasonable business use. That Augusta loophole is different than the business use of your home that we're talking about today. Okay? That is different. I will do a video on the Augusta loophole, not today, but I will do a video on the Augusta loophole. It is completely different from this business use of your home. When we talk about the business use of your home here, we are talking about regular use of your home, regular and exclusive use of your home. Okay, so you have an established home office that is a regular place of business. The Augusta loophole is saying, we're not renting it regularly. We're renting it less than 2 weeks a year. And, maybe we're renting it 5 days. And it's not a regular use of the home. Okay, so this is different from the Augusta loophole. Don't get this confused with the Augusta loophole. This looks completely different. Okay? So this is the business use of your home. I hope that was helpful. If you have any questions, let me know in the comments. If this was helpful, I would greatly appreciate a like and subscribe, and I will see you guys for day 8.